Hello and welcome to CNBC-TV18's Mumbai Newsroom. I'm Sumaira Abdi and you're watching MF Corner. Today we have a very exciting chat for you. One of the youngest mutual fund houses in India, that's Quant Mutual Fund, which in its current avatar as an AMC has been running since 2018, and they have shown some remarkable performance in the last 2.5 years. And let me get you some stats to prove that. The average return of the Quant Mutual Fund equity schemes between the 24th of March 2020 to 29 July 2022 has been 233% compared to 126% by the Nifty. 10 of their 13 equity schemes have delivered an outperformance in excess of 100% during this period. The average performance compared to the benchmark has been 92%. And this stunning performance is reflected in the growth in their assets under management as well, which now stands at 10,000 crores. Now, over the last 2.5 years, their schemes are ranked either first or second in most of their categories. So what explains this kind of phenomenal returns? And more importantly, is it going to be sustainable? Let's welcome Sandeep Tandon, founder and chief thought officer at Quant Capital, to discuss the fund house's commendable performance. So Sandeep, first of all, thank you very much for joining in. Congratulations on creating this kind of wealth. And the first question naturally is, what has been the key driver of this performance? What is it that Quant is doing, which the rest of the industry hasn't been doing so far?
So as we always try to explain that we have built our own framework, investment framework, we call it VLRT Framework, which is V represent valuation analytics, L represent liquidity analytics, R represent risk appetite, which is sentiments, and T is the time. Okay, so this VLRT framework has been built on the background of multi-dimensional research, where we try to combine qualitative, quantitative, and behavior aspects. See, we have all lived with only unidirectional approach instead of multi-directional research. We only talk about valuation. That's the way I have also grown in last 30 years or so. And over a period of time, we realized that pure valuation analytic doesn't help. It just gives you entry, but never gives you the right exit. So, and I have this framework, which we talked about, VLRT, has been built after many mistakes which has happened in last many years or maybe a few decades. Okay. So it got built after a lot of learning. And this is something which we are very proud of, that we have put a process in place, and which is one of the key reasons of this outperformance. Because one of the important learning which I want to talk about, see, we all know in this industry that one should not be emotionally attached with any stock. We always say never get married to a stock, but it never happens in real life. When you are associated with a particular company, a particular sector, over a period of time, you have natural attraction and you get carried away. So we always talks about what happens. So the key thing which we are putting in place, that how to remove human biases. And that's the reason this process has been built, where we try to quantify everything, including the sentiments data. Represent that we can quantify anything which affects market, A to Z of the financial market. That is something we try to quantify, and that really help us in shortlisting sectors, stocks, or even the VLRT framework can be implemented global level.
Okay, so basically, this is driven by what, AI, or is it the fund manager's expertise? I mean, what runs this VLRT framework?
So this is a strength of data analytics. We call it predictive analytics, so which can be a backbone of, or that's the way the AI or machine learning today people talk about. We have been doing predictive analytics for nearly 30 years now, and that's a time when nothing was there like AI or machine learning. So it's a form of data analytics, but instead of doing a postmortem analysis or reactive analysis, we do preemptive analytics. Okay, or we preempt, and this is what we defined as a predictive analytics. We try to create a picture based on multi-variance model which we run, and try to understand how markets will be if we combine these data points put together. So it's like a picture get formed when you connect the dots. Our ability to connect global macro, global geopolitical volatility, even earth analytics. Okay, so anything which affects markets and various cycles, we try to quantify and then try to form opinion. And this is one of the reasons we are relatively more successful in able to predict the markets.
Okay, so can you explain your investment part of this process? I mean, what does your investment process look like? What are the steps, etc., if you can explain it?
So, Sumira, we as a house, we are a macro house. So everything starts from a global macro perspective. So first we implement VLRT framework at the global level. Okay, so let me explain you. Okay, it's very easy to talk about, but very difficult to explain sometime. Let's take example in what happened in March 2020 and then September 2020 and where we are currently. In March 2020, when COVID happened, okay, that's the time everybody was very much worried. If I have to put it in a mathematical manner, the global risk appetite was a lifetime low and global liquidity was a lifetime high. This is a lethal combination for a bull run. And this is one of the reasons, if you have to look at the VLRT framework, that has given a very aggressive view. This is a time to go all out. And we participated on the front foot. So VLRT framework supported in the March 2020 lows in terms of identifying the bottom. Similarly, in September 2021, okay, September to October 2021, we spotted there was a euphoria globally. Money flow towards global equity was a lifetime high and is a multi-decade high actually. And if you look at that time as compared to March 2020, liquidity started drifting down, risk appetite was shrinking. This is a classic sign that easy phase of bull run got over in October 2021, and there was a euphoria in US market particularly. There was a euphoria which we spotted in the growth stocks, and the value there was no euphoria. So one signs of reversal, what happened in March 2020 got reversed in September, October 2021. And similarly, very recently in June 2021, we came out a call on Reflex Rally, where we talked about that risk appetite has reached an exhaustion point, liquidity is about to reverse, and valuation has turned attractive. So it's another reflection point. So it's something like we try to implement a VLRT framework first from a global macro, then we come to India specific, and then we try to see within India whether it is we are in risk on environment or risk off environment. If we are risk on environment, we play on front foot based on the sector rotation, and we are relatively more aggressive. So idea is that in risk on environment, generate extra alpha, which will help you in a difficult environment. So March 2020 till September 2021 is a risk on environment. Similarly, from October, November 2021 till 15 June 2022, it was a risk off environment. In risk off environment, we play on back foot. We are not very aggressive. The whole idea in risk of environment is to protect the wealth. You might underperform in that period, but that doesn't matter because you have generated alpha in good times. So you have to protect your cash, okay, or protect your holding. That's the key thing we define. And then we implement, based on this environment, we try to identify the sectors or stocks through VLRT framework, which gives me a better timing. So when we talk about in VLRT framework, T is the timing is not linked from a trading perspective. Timing is all about how well we can reduce our risk. So when all three analytics, valuation analytics, liquidity or risk appetite analytics are skewed on one side, it gives me better timing. So VLRT framework is actually a very good risk mitigation tool for us. And this is one of the reasons we have demonstrated, we implemented VLRT framework from September 2019, most of the schemes. So it's nearly 3 years we have seen the outperformance of VLRT framework.
Okay. So you wouldn't identify entirely either with the value or growth philosophy, right? Yours is your own standalone philosophy.
No, we don't have, we have three investment philosophy: active, absolute, and unconstrained. When we talk about active is a dynamic way of money management, because we believe that we live in a dynamic environment and hence your money management style also has to be equally dynamic. Then we talk about absolute. So when we try to raise money, is a typical in the industry, we raise money and we talk about certain IR and absolute numbers. When we deliver, at the end of the day, we talk about we are a relative product. So it's our endeavor to generate absolute return for the investor. And third principle is unconstrained, which is the most important one for us. It is unconstrained. So we are not constrained by any philosophy. So we don't believe any thesis of any philosophy or growth or market cap or sector agnostic. So we are sector agnostic, market cap agnostic, and we are not constrained by any thesis. We are opportunists. Wherever we see opportunity based on our framework, which is demonstrating, we'll try to capture, even if there is nobody buying those stocks. Sometimes stocks are trading in neglected territory, beaten down zone. So from a behavior perspective, we believe that every stock has certain behavior characteristic. Okay. So, and sometimes stocks are in the most admired category, like September, October 2021, where the technology stock was the most admired category. We exited completely. Similarly, we try to identify in the stocks which are neglected territory, or what we call it neglected zone, like September 2000 or between September to December 2021, ITC was a very classic example where some of these stocks was completely in the neglected phase. So we try to capture the inflection points in the market. So we don't believe in a momentum style of investment. We believe in the extreme high level or extreme low level. So extreme euphoria or extreme panic. That is something we try to capture through our predictive analytics, and generally we get it right for most of the time.
But, Sandeep, the conventional wisdom has always been to buy and hold, right? That over the long term, you will make wealth. Don't try to time the market, because it's not possible for even, the best of investors to do that. But your entire philosophy is contrarian to this buy and hold approach, right? So would you say that buy and hold is the lazier approach, or is conventional wisdom wrong?
No, Subira, is slightly different. We try to understand what type of environment we are operating. So we work on a concept like adaptive asset allocation, so tactical or strategic allocation. For us, to very important to understand what type of environment, macro environment we are, and then accordingly to identify the opportunity. Let's say in 2017, we spotted that 2018 till 2023, we call it volatility expansion phase. The employed vols of the most of the asset class globally will remain elevated. Now, in this type of environment, your buy and hold strategy will underperform and actually underperform. And that's the way the genesis of dynamic style of money management came into picture for us. So we are not against buy and hold strategy. We believe that till 2023, this thesis will not be very effective, and hence we have not participated. Maybe if data point change and says next 5 years or next 3 years, this sort of approach will work, we don't have any allergic or any resistance to adapt that also. But we try to take longer term perspective. Well, let's talk about in September, October, we spotted that growth stock has seen a euphoria. So we spotted a euphoria, but if you dissect the euphoria was confined to the growth stock technology names, where value stocks were at the lower levels. There's no signs of euphoria. So we have taken a very aggressive call, saying that this decade belongs to value. Okay, this is a value stock, could be a decade story. Emerging market could be a decade story. Indian particularly could be a decade story relative to developed market, particularly to US.
Oh, fair enough. And, it's this kind of absolute conviction, I guess, that people want to look for in an active fund manager. But we're going to take a very quick break. On the other side, the other question that most people want to ask Sandeep, which is this performance sustainable? Stay tuned. We'll be right back. Hi, welcome back to MF Corner. We're in conversation with Sandeep Tandon, founder and chief thought officer at Quant Capital, and we're talking about the stunning performance that the AMC, Quant Mutual Fund, has shown over the last 2-3 years, and basically what is the future? Can this run rate sustain? But before that, Sandeep, I have a few more questions. You mentioned that how timing plays an important role in your VLRT portfolio, right? So that means obviously you're looking at perhaps a higher churn in stocks than, say, many of the peers. As well, you mentioned that, you look at often neglected stocks or sectors, right? So how do you manage to maintain your superior risk-adjusted metrics despite, playing on so many levels?
So, Sumera, let me answer this question about churning, because I think this question comes quite often to us from various distributors and investors, okay? I think this is a myth, okay, when people talk about churning is bad, okay? Because there's no terminology in the portfolio like churning. It's all about rebalancing of your portfolio. Since we run our portfolio in a dynamic manner, and hence our rebalancing also happens in a dynamic manner. Let's look at a private equity. Their rebalancing happen between 5 years and 10-year horizon. Some people rebalance their portfolio on yearly basis. Some could be bi-monthly basis also. So depending on how you have defined your rebalancing approach, we believe that our style is dynamic, and hence our rebalancing also has to be equally dynamic, which leads to sometime higher churning. Okay. Now, rebalancing our portfolio is nothing to do with the churning aspect. It's not intentional. The whole idea is that if we can optimize the risk on and risk off environment, and then we can capitalize on this trend. Okay, so if we are seeing a trend on based on the predictive analytics that risk of environment has reached an inflection point, or risk on environment also has reached an inflection point, we have to reverse our strategy and we have to shift our stocks to certain sectors or certain stocks which could be more defensive for risk of environment point of view. We will be like to balance our portfolio. That can lead to a churning, but it also gives me better risk adjusted return. So basically, by more churning, the way industry looks at, we are trying to reduce our risk in our portfolio, and that does not mean that we are not very focused, we don't understand what we are doing. A lot of people comment saying that the strategy is not clear, they keep on churning. No, our strategy is very clear, that we are in a very, very challenging environment globally. It's a volatile phase, and I like to capitalize. So we always say, if it's a volatile environment, a lot of people get worried. Let's say if markets settle down, then we'll participate even at 20% higher. Our thesis is that if you can make and understand volatility analytics, if you can make volatility the invisible man, your best friend, you can manage these risk-adjusted returns better than the industry.
So, Sandeep, would a volatile market therefore be more conducive to your investment process, or a long bull run, I can imagine, but would prolonged periods of a bear market, not help you sustain? I mean, I'm just trying to understand that, is there a particular kind of market in which the funds would perform better?
No, that's like we first thesis is to understand the environment. If environment is volatile, we will play accordingly. It's like your strategy has to be linked with the environment. You can't play the same investment thesis like buy and hold, which we have been taught for donkey's years, and then we have been living with that. That may not be very, I think that phase and that era is over. Okay. In a dynamic world, you have to revamp your portfolio based on the environment. So if you look at from September 2019 till September 2022, nearly 3 years when we implemented this framework, we have seen many cycles of up and down. We have seen sharp fall also in COVID. We have seen a very deep correction in the month of last 6 or 8 months thing. So we have managed that. It's not like the performance only came in the very good environment or the easy phase, what we call it. But I think the way we look at it is not our endeavor to actually generate this sort of alpha which got generated because of the dynamic style of money management. But our endeavor is to generate superior risk-adjusted returns. So if you really look at our analysis, don't look at just in terms of outperformance what we have given. Look at the Sharpe ratio or Sortino ratio, the risk-adjusted returns or the downside protection. I think our all 14, 15 schemes which we manage, our risk profiling or the Sharpe or Sortino ratio should be the best in the industry. That's the way we define ourselves, that we have to generate superior risk-adjusted returns. So we are very conservative house. We don't take unwarranted risk. Okay, and that's the reason we quickly revamp our portfolio based on the changing environment.
But would this hyper-dynamic approach, or can I say a higher sensitivity to market changes, make your schemes more expensive?
Not at all. Okay. First of all, one has to understand the small brokerage which you pay to churn this portfolio, revamp your portfolio. That's the way market looks at, versus the impact cost. Okay. So for me, the impact cost of a portfolio of particular stock is far more superior. If let's say, if I have to prune down exposure, I have to buy and stocks rally quickly. Okay. And the impact cost will be much higher. So we try to see and take advantage of a low impact cost also. Okay. So we give a lot of weightage on the, let's say example, September 2021, when we spotted the impact cost of the overall market is changing. We were very first to revamp our portfolio and focus on the illiquidity aspect in our portfolio, immediately replace many illiquid names in our portfolio and try to increase our weightage from small to mid to large cap. So it's a dynamic way we look at, and we have demonstrated that. So it doesn't matter, okay, what type of environment which we are operating.
Okay. Can you explain your focus on the accumulative advantage rule? I mean, what is it and why does it matter to your funds?
I tell you in a very simple terms, without getting into any complexity, the way we look at is market is all about behavior. See, from a behavior perspective, the inflection points thesis is far more superior than any other thesis, because we all have been taught that timing is very important, or the from our thesis point of view, exits are more important than the entry. Okay, the challenge which I have seen, I have learned over 30 years, is that our entry points was very good, but we never got the right exits. And that's the reason the entire thesis of VLRT framework, which we have built, is all about identifying the extreme in the market. Any extreme level we need to exit if it's a euphoria, and any extreme on the other side also should be looked as a buying opportunity. So we are not believer of any other thesis apart from the framework which we built.
Okay, and finally, Sandeep, the most important question, is this kind of superlative performance sustainable?
So I tell you, we are very confident about our philosophy or the framework which we have built over a period of time. And I said that this framework has been built after multiple mistakes, which I made in my personal capacity, or the organization which we have learned over a period of time. So it's been nearly 3 decades we have been learning in this market. So it's learned from the mistakes. So we are very confident that, and it's not that we have arrived in life, it's an evolving form. Okay, so VLRT framework, we try to capture everything which affects markets, whether you talk about global volatility, whether you talk about magnetic fields, whether you talk about earth changes or climate conditions, or you talk about the liquidity indicators, or you talk about the sentiments data points. So, and these data points are also evolving. Like few years back, Bitcoin was not there. Today is the best risk appetite indicator for the next generation, and we use it quite well. We don't trade in Bitcoin, but it's a very important risk analytics for us. So I think it's an evolving form, and we think more the data points, better is for us. And we are very confident that this framework has been built, and it is our responsibility to ensure that that learning never stops.
Sandeep, very, very heartening to hear that. Indeed, for us as well, learning never stops, because today we have learned that everything can be turned on its head, right? And I guess Quant Mutual Fund has demonstrated just that. That there may be a philosophy which everybody may follow, the majority opinion, but you can still go against it and perform. Thank you very, very much, Sandeep, for joining in, and thanks very much at least on behalf of your investors as well. Well, you can call them mavericks, you can call them outliers, but the one thing you cannot do is ignore them. That's Quant Mutual Fund for you. That's about all we have on MF Corner today, but do remember to keep sending us your queries, and we'll have them taken up with our experts through the week. Thanks very much for watching. Do stay tuned. The team of Closing Bell will join you next to take you through the last hour of trade.